Have you noticed something strange? Just when everyone believes the market is finally breaking out, boom, it suddenly reverses. And, well, only after trapping a whole bunch of traders does the real trend actually begin. So is it just bad luck? A coincidence? Not always. Welcome to This Explainer. Today we're going to understand exactly why so many strong trends start right after a false move. We'll explore the simple mechanics behind this and see how human predictability and liquidity basically shape the charts you look at every single day. Because as you'll see, the first move isn't always the real move.
Let's start with a really frustrating reality. You know the feeling? You sit at your desk, you spot a textbook breakout, you enter the trade with full excitement, and then, almost instantly, the market just reverses and hits your stop loss. It literally feels like the market is personally hunting you down, right? We can all picture that moment, scrambling in panic, hitting the exit button in complete despair. But I want you to know, it isn't personal at all. It's just market mechanics. And once we understand these mechanics, we can stop being that trapped beginner and actually start seeing the real opportunities hiding in the price action.
So, to understand why this happens, we first have to talk about market structure. Now, I know you already know this. It's the foundational language of any chart, right? We're talking about basic support, resistance, swing highs, and swing lows. If you want to understand any movement in the market, you absolutely must speak this language fluently. Without it, price movements will always feel like this random, chaotic mystery, and you'll just be forever guessing where the market might go next. We're all taught from day one to look for these three basic setups: bull trends making higher highs, bear trends making lower lows, and of course, sideways ranges where the price just bounces back and forth. You open any trading book, take any beginner course, and well, this is lesson number one. Everyone learns this exact same thing. But here's the catch. This shared knowledge, that is exactly where the breakout illusion begins. Because when everyone is looking at the same obvious levels, everyone tends to act the exact same way. You see, when a resistance level becomes too obvious, human psychology just takes over completely. Millions of retail traders end up making the exact same emotional decisions at the exact same price levels. They rush to place buy orders just above the resistance line, fully expecting a massive breakout. And naturally, they place their stop losses just below it to stay safe. Because so many people are doing this at the exact same time, it creates this massive, predictable cluster of behavior right around those obvious highs and lows. Now let's see how this plays out in reality. Here we have a classic false breakout. The price pushes past resistance, right? Aggressive buyers immediately jump in because, well, they're taught to buy the breakout, and they tuck their stop losses just below that line. But then, a sudden, sharp rejection downwards proves that not every breakout is real. The traders who reacted purely on excitement are now trapped in a losing position, and the market quickly moves against them.
Now, hold on a second. You might be thinking the big players have some secret software showing your exact stop loss. Actually, scratch that. They don't. The market doesn't know your specific position, and there is no hidden group secretly plotting against your trades. But large institutions do need massive liquidity, meaning eager buyers and sellers to fill their huge orders without completely crashing the price. And because emotional decisions place so many retail traders at those exact same obvious levels, institutions know, probabilistically, where that liquidity is resting. It's not a conspiracy, it's just pure mathematics.
Think of it like a giant iceberg. The obvious chart pattern you see, the support lines, the trend lines, the resistance, that's just the tip of the iceberg, visible above the water. But beneath the surface, the real market movement is driven entirely by this constant search for hidden liquidity to fill large orders. Again, this doesn't mean the market is rigged. It simply means what you see on the chart is only a fraction of the story. The real driver of price is, and always will be, the search for liquidity. And that brings us to a fundamental concept, the liquidity sweep. What happens is, the market often briefly moves just past an obvious high or low. This naturally triggers that massive cluster of pending breakout orders and resting stop losses we talked about. When those trapped traders get stopped out, it generates a massive wave of buying or selling liquidity. This allows those larger institutional orders to be filled super efficiently. And once those orders are filled, the price swiftly reverses. So you see, the liquidity sweep is a purely mechanical event. This entire dynamic relies on one very simple, very human emotion: FOMO, or the fear of missing out. We've all felt it. Beginners see a massive green candle. They panic, thinking they're going to miss the rally of the century, and they buy late, just scrambling to get in. They react to the excitement instead of waiting for actual evidence. And because of this emotion, they get trapped the second the market naturally pulls back. The market just effortlessly absorbs the impatience of traders who act purely on their emotions.
Notice what happens right after a false move sweeps the liquidity underneath a support level. The retail stop losses get triggered, causing widespread panic. But then, the market structure shifts and the price rallies powerfully in the direction everyone originally expected. The real trend only forms after the necessary liquidity has been secured and the emotionally driven traders have been shaken out. The sweep wasn't a punishment for you. It was literally a prerequisite for the real move to even begin.
So, to thrive as a trader, we have to make a fundamental mindset shift. New traders react to excitement, they chase big candles, and they enter trades aggressively out of FOMO. Professionals, on the other hand, react only to evidence. A smart trader relies completely on patience. They calmly wait for a retest, and they absolutely demand confirmation before risking a single rupee of their hard-earned capital. It's the difference between blindly hoping a trade works and knowing the probabilities are actually on your side. Let's look at how the smart trader operates in these exact situations. They completely ignore that first explosive move. Instead of blindly buying the initial breakout, they wait patiently. They wait for the market to pull back and retest that newly broken level. They understand that the first move could very well just be a liquidity sweep. The retest and the reaction that follows offer the actual structural proof they need to ensure the new trend is genuine. Let's break this down into 3 simple mechanical steps you can use for your next trade. Step 1, wait for the initial breakout. Just watch it calmly, but whatever you do, don't touch it. Step 2, observe the retest. Watch exactly how the price reacts when it comes back to that level. And step 3, enter only when you get a clear confirmation candle, like a strong rejection from that retested support. Remember the golden rule here: no confirmation, no trade. Absolutely crucial. All right. To wrap up this explainer, I want you to remember these core rules for your trading journey. Number 1, not every breakout is real. 2, liquidity almost always exists near obvious levels. 3, false breakouts often happen right before a strong trend begins. 4, always wait for confirmation. And finally, trade probability, not emotion. If you stick to these principles, you'll stop falling for the breakout illusion and start trading in tune with the mechanical nature of price action.
The strongest trends almost always begin right when the majority loses their patience. So, the next time you sit at your screen and see a perfect setup, ask yourself, are you going to trade the first emotional move, or are you going to wait for the confirmed move? Thank you so much for joining this explainer. Be disciplined, manage your risk patiently, and we'll see you in our next lesson, False Breakouts versus Real Breakouts, How to Tell the Difference.